A very good afternoon, everyone. I am Pragati, host for today's call. I track macros and strategy. So this call, as you most of you are aware, is a monthly call for our monthly report, Netra, which we release on the 5th of every month. And the April edition, which is the latest edition, happened to be released only yesterday. This time, I won't give you any gist of what it is going to be about. I'll leave you with just one thought. After almost 2 years, we've dropped our conservative stance on equities and moved to a more moderate allocation in this space. For anything more on this, believe me, you want to be in this call, and I will invite Sahil to take over to give you a more deep understanding of what it is going to be about. But before we start, just as a side note, that you can post your questions during the course of the call in the question answers tab on your screen, and we will take them collectively towards the end. Over to you, Sahil.
Thank you, Pragati, and good evening to all of you. We'll start off with this month's presentation. We'll talk about a few numbers. We'll talk about what is going on with the market right now, and we'll more importantly also talk about what led to change in stance. One thing is very important to talk about upfront, that just because we think that we should be more constructive on equity doesn't mean market should rally or it will start going up from tomorrow. We have no idea, and even if we change stance after 2.5 years, it means nothing, right? What all we are trying to show you is data, and how do we interpret data at this time, and how it can help you in forming a opinion looking at data. So we'll start off with the presentation for the month of April, and it will give you a highlight and gist of what we've written. So it's a longish presentation. I will try to cover almost all of it. So first is that why should you be more constructive about Indian equities? So just to give you a background, back in 2024, when markets were rallying, uh, I think about March and April, we clearly stated that we think valuations are high, earning growth is peaking out. There are not many pockets in which valuation comfort is present, and therefore you should tone down your expectation from the market, be more focused on hybrids, be more multi-asset in nature, look for gold and silver, uh, look for short-term bonds, look for global equities. That was the standard, ideas that we had at that time. Today, things have changed. Now we are into almost 2.5 years of sideways market with this current March correction kicking in. And this has changed some numbers. Now we look at what those numbers are and why have we changed our stance to more constructive. First is we say that you should raise your equity exposure. Now, what does this mean? Earlier, we were saying that should be more conservative. Your expectation from equity should be low. Whatever money that you want to put in equity should be either through SIP or only through hybrids. That was our stance. Today, we think that you can add equity exposure. You can look to buy lump sum outright large cap category um funds. Second, you can also look to buy hybrids like aggressive hybrids, uh, the aggressive hybrid category, which has a large portion of equity built in. And also, you could expect that a lot of hybrids which come from us will also raise equity weights. And that is what we have done specifically over the last 10-15 days. And why this stance? First, that we think that valuations have now become more logical than they were earlier. And specifically when we think about the large cap valuations. When we were writing this, when Nifty was below 22,300, and this time we also released some of these insights during the last 10 days, just to give you a idea on what we were thinking about. So some sectors like banks, IT, insurance, housing finance, parts of FMCG, they account for nearly 50% of market cap. They have now come below average valuations or long-term valuations. Second point, let's look at the Nifty. We'll go to the next slide and we'll talk about it. Um, let's look at the Nifty valuations. Look at the long-term average valuations. So when you look at the data which is present in the public domain, you will find that all that data takes into account two types of Nifty valuations. One, after 21-22, NSE started publishing consolidated price to earnings ratio, and prior to that, it was standalone. So the data that you see in the public domain is a mix of standalone and consolidated data. This series that you see on your screen, we created and back created, recreated this based only on consolidated earnings. So this is a consistent data from 2003 onwards, almost 23 years of data. And when you look at this data, long-term average valuations for Nifty is about 18.9x. That is the average price to earnings multiple. As things stand today, when we were writing this, of course, numbers change on a daily basis because price is changing. Nifty was trading close to 19.3, 19.5 trailing multiple or below 20 times. Now, what is special about this is that this did not include the March 2026 quarterly earnings because the trailing multiple was available only till December earnings. So if you just include March earnings because you already know that we are already in April. So common sense tells you that March earning is now trailing 12-month number. So if you just include that number, it will see a bump of about 2 to 2.5% because it's a quarterly number. You add that to the Nifty EPS. Also remove the one-time labor charge from Nifty EPS. You will see that Nifty is actually trading below long-term multiple now, around 18.5 or lower, right? That was the low that Nifty did earlier. Is this cheap? We don't think so. This is not a cheap multiple, but certainly it is below long-term average valuation. Second, is it a fair multiple? What is a fair multiple? Even in the past, DSP Netra, even in our webinars, if you go back and see, number of times I have discussed what could be the fair multiple of a stock, right? So for example, let's say if Nifty was a stock and it has a return on equity of 16% and a long-term earning growth of 10 to 12%. So at the payout ratio that it trades, Nifty fair value should be between 16.5 to 18 times. Currently, it is trading at about, let's say, 18.5 times according to the mathematics that I just told you, which means that we are somewhere below long-term valuation and slightly above fair value. We are caught in that zone. Now, if you look closely, how many times has Nifty dipped below average valuations? Only during times of crisis, it goes below average valuations. Now, one very special case is that you can see that prior to 2015, we spent a lot of time below average valuation. Why did that happen? Because we were in that crude oil era, 2011 to 14, where oil was at $100. And Indian companies were really struggling. Profitability was very low. Between FY14 to FY18, corporate earnings growth in India was 4% CAGR, right? So the average multiple would have been much lower. Second, and more importantly, which is very important takeaway, that Indian multiples have actually expanded. They have gone up over a period of time. And if you remember just a few Netra editions ago, we actually wrote that it's possible that in India, new de-rating cycle has started, which means that our PE multiples have started to fall, right? Now, we are no judge that what will be the final number or where the multiple will stop. One thing is clear that, I'm sorry, that average valuations are now back, right? And if you look at the code that I have written here is that if there is a high quality business available, and if it comes to fair price or average valuation, there is no harm in allocating moderate amounts of money to that business. And this is what we see in Nifty today, right? It has come back below average valuations. Is it a high quality index? It has the second highest ROE in the world after United States. We've repeatedly shown this in data. So when it comes to below long-term average valuation, we raise our equity weights by one notch. So that is what we are doing. Are we saying aggressively buy equity? What do I mean by aggressively buying equity? By aggressively buying equity means that you go to your highest equity allocation, right? So what is the highest equity allocation? For example, if a dynamic asset allocation category is allowed to go to 80 to 90% of equity, that is aggressive. If it is allowed to go to 20, 30% equity, that is extremely conservative. maybe right now we should be in the middle, right? We should be maybe close to 50-60%, closer to 60%. That is what I mean by raising equity weights, increasing your equity exposure. Now, if we are going to increase our equity exposure, uh, why should we be doing that? So first, I told you average valuation. Second, India's valuation premium has also come down significantly. So if you look at the left-hand chart, you'll see that India's valuation compared to United States or S&P 500. Why have I compared to S&P 500? Because both these markets have the highest ROEs in the world, two of the highest quality market. It makes sense to compare. So currently, X of COVID, we are very close to second lowest readings versus S&P 500 in terms of relative valuation. When you compare to emerging markets, we are very close to average valuation, right? Our valuations are very close to average. One noteworthy point is that when you compare to emerging markets, in case of India, ROEs have actually not gone up as much. Earlier, our ROEs were 20% plus. Now, ROEs are around 16%, lower than the previous cycles. But X of India, other emerging markets have suffered badly. Their ROEs have declined much more than India, and therefore our premium to their valuation is higher. So even after a decline, you will see that we are still trading at a premium. The reason is that over the last 10 years, other emerging market has done even worse compared to India. Third, why should we be buying at average valuation? Why not wait for cheap? Sorry. First is that it's very difficult to ascertain or reason out why should we get cheap valuations other than predicting crisis like a COVID crisis or a global financial crisis, which we don't have the ability. Nobody knows the future. It is very difficult to get absolute cheap valuation. For example, 15 times multiple or 12 times multiple. And therefore, it makes sense to, when you get average valuation or fair value, you start increasing equity allocation. That is what we are doing. And we'll tell you where are we telling you to increase allocation. That is the most important aspect. We will come to that. In this cycle, in India, you can see, I told you earlier, in the previous 2008 cycle, our average ROEs were 22%, peaked at 25. In this cycle, they peaked at 16 to 17%. Why has this happened? Because in this cycle, sales growth was not very high. A lot of profit growth came. How did profit growth come about? By two means. One, no large equity dilution, right? Second, huge amount of debt repayments. Balance sheets were cleaned up significantly. Whatever equity dilution you see came through IPOs, not from existing companies. From existing companies, it was much lesser, right? So all the listed universe companies, they tried to clean up their balance sheet, repay their loans. Top line was not growing. Secondly, profit growth was much higher. What was the reason? Margins were very high. So it was a big efficiency bull market. In this bull market, uh, because of lack of high sales growth, fixed asset turns were not very high. That is one of the reasons why ROEs were not very high, right? Now, as we stand today, Indian corporate balance sheets are very clean. If you go back to about 2 to 3 Netra editions, you will see we printed a table showing you that corporate India balance sheet is in the best health as of today. And that will be a basis for the next important cycle in the market. As of today, we think that if a new capex cycle were to come or uh, corporate India sees visibility of demand recovery, the ROEs can improve in the next cycle. Now, this is a hypothesis, or maybe it's not a theory, it is just a hypothesis. Will it play out or not? We don't know, right? But one thing is very clear that in the next cycle, a very important ingredient will be loose monetary policy. Whether we have it or not, whether it will happen or not, we have no clue. But one important conclusion from this slide, the health of corporate India balance sheet is going to be a very, very important consideration. In fact, uh, internally, we did an analysis to look at which are the companies which have the best balance sheets in India. That is a very good starting point, right? So if you look at what has happened to Nifty in terms of prices is another very interesting aspect. So it's very clear that India is in a bear market right now. We saw around 26 to 27% decline from the top in terms of US dollar returns. So if you look at the USD returns, Nifty priced in US dollar. There is also one more index called Dollex, DOLLEX, which is nothing but Sensex in dollar terms. You'll see that both are now back to September 2021 levels. Almost 4.5 years of returns for people investing in dollar terms. For example, FIs have been washed off. So price froth is completely gone. And you can see it is also one of the most oversold reading that we've seen. Why is this important? If you remember, we published a chart saying that if you buy equities when they're expensive, you get the returns of bonds, but with volatility of stock. And we showed you that there are periods, 5 years, 10-year periods where equity markets deliver nothing. And today you have a live demonstration of the same concept where in dollar terms, Nifty has delivered nothing. And one of the reasons for that happening was high equity valuation, right? Or maybe we are ascribing that because it is now available in the hindsight, but also in real time, it was visible that high valuation could play a spoil sport. As we stand today, now the opposite is true. Now we are at a juncture where valuations are below long term average, but just the noise around us will not allow us to act, right? It will make sure that we have a lot of questions in our mind and a lot of our recent drawdowns, bad returns, or no returns of the recent period will weigh on our psyche and will stop us from continuing long term investment. But this is a very important indication. From this slide, you can see that price froth has been completely removed, specifically for overseas investors. A lot of overseas investors are passive in nature. They buy baskets like MSCI or any other passive basket, which delivers very close to index type of uh, portfolios. Now, one very, very important question which has been going around is when will FIs come back to India? Now, we don't have a date. Nobody has, but we have a framework to think about. First is that very importantly, FIs do not have a positive correlation with returns, which means that if FI begins to buy, market will start going up. That's not true. In fact, opposite is true. When markets start to go up, FI starts buying. That is likely a better sequence of events than the other way around. But why FIs are more important is from a balance of payment perspective. When you have all the noise going around, for example, with oil on the boil, uh, return of FDI and FI becomes a very, very important metric for Indian balance of payment. Now, this data tells you two very important facts. One, that Indian rupee, which is a very important consideration for foreign investors, because, for example, if an investor invests in India when rupee was 90, and let's say if rupee goes to 99, that investor straight away loses 10%. So, an investor is better off overseas investor if rupee is stable. Now, when will the rupee become stable? When it is already very weak or it is oversold and undervalued. That is the time where foreign investors will be more positive on the rupee, more stable on the currency. And you can see that the real effective exchange rate for the rupee is now as low as it has been for a very long time. We are at about 90.5. Last time we were below this level was in 2013 crisis, and prior to that in global financial crisis. This is the third time we've come to that level. By no stretch of imagination am I saying that this cannot go to 85. Maybe it can. We don't have the wherewithal to predict whether it will go or not. But one very clear indication is that it is undervalued. Rupee, the run on the rupee or the depreciation that we saw on the rupee is probably in the last leg, which makes it attractive for foreign investors from a investment point of view. Second, if you look at India's capital account, it has turned negative for the first time. We haven't seen this data. These two are very strong contrarian indicators. What do they tell you? That lot of negatives, lot of things which can go wrong for the rupee have already gone wrong. So we feel that a lot of it is already in the price. Now there could be a question that with all the noise around oil, and if oil goes to 150 or oil goes to $200, of course these things will deteriorate even further, right? But if you just go back to January 2026, Nobody knew that in Feb and March you will have this war and you will have trouble thinking about oil, right? So similarly, today, sitting on 6th April, we don't know what will happen in May or June. And we also don't know what will happen in May or June of 2027. So if you take a 1 year perspective or 5 year perspective, if rupee is undervalued, Nifty is at average or below average valuations, close to fair value, and lot of sectors and stocks, which I will showcase to you in the next few slides, are available to at cheap valuations. If you think from a 1 to 5 year perspective, it does make sense to increase your equity exposure rather than wait. And that is the point of view that we have right now. Next is, where is this cheapness or below average valuation present? So if you look at the large stocks, the top 10 stocks, we've taken the percentile ranking of price to earnings ratio of Nifty top 10 equal weight index. Why this is so important? Because this is an equal weight index. All stocks get equal weightages. It's at 17th percentile. Only time it was cheaper was in 2020 or 2016 crash, right? When markets fell 25%. So this is the third lowest reading, which is available in the last 10 years, which we think is good enough. Lot of stocks within this basket also come at 15-year low or 20-year low valuations, which we'll see again. So largest stocks of the market are at low valuation. This is all the 10 stocks put together. All of them are now available at or below average valuations. And 80% of the portfolio is now available at or above average ROE. So not only they are valuation wise lower today, but their quality is actually better. This is a very, very important metric. The only point is that because they have not done well recently, a lot of investors will, shy away from them. They will think that because they have not done well, they might never do well, right? But when you compare the full landscape of investment ideas available, you will see that large caps and the largest caps are available at very attractive valuations, and their quality has not deteriorated. And this makes the case even more stronger. The next is small and mid cap universe. Now, this is a very, very interesting case where small and mid cap valuations have still not deteriorated enough when you compare it to large cap. So, if large cap are below average valuations, small and mid cap are still above median average valuations. If you look at the indices, small cap index has somewhat corrected. More opportunities have come about. And we think that from about 25% of the universe, which was in below average valuation category, maybe it has progressed to 40. But overall valuations are still expensive. But when it comes to small and mid cap, we think that active managers can do a better job rather than picking indices or forthrightly putting money here. This is the space where still SIPs will make sense, or possibly a buy on decline will make sense, or active managers which have valuations and business metric at the heart, giving money to such managers will make sense. The next is a statistical important point, which will tell you how Nifty has behaved price wise. Now, we looked at data from the past, and one interesting metric came about. How many times has Nifty closed negative for 4 or more consecutive months? Okay, so there are only 7 such instances. 6 are already completed. If you look at the data, when you look at the full decline, usually the full decline percent plus. But in the 3 month ahead period, when Nifty declines for 4 months or more consecutively, usually the index has done better. 6 months forward, the improvement has been significantly high, and 1 year forward, the returns have been significantly positive. Right? Even if you look at the median returns are close to 20%, which means that generally 4 consecutive months of decline coincides with what we call capitulation. One interesting data point is that in these 4 months, what are these months? December, Jan, Feb, March. The market has not declined a lot. It has declined only 14.5%, which is much lower than the previous readings. But it has brought down valuations to much lower levels. Another very interesting um, data point occurred last week when Nifty fell for 6 consecutive weeks. That itself is a very, very important indication that tells you that selling was rampant. Now, what does these number tell you? A, it tells you that when selling happens, the sellers are not discriminating between good or bad, between low valuation or high valuation. They are selling because of fear or because of panic, which creates more opportunities. And that is what this data tells you. Second, this data does not have predictive power. It doesn't mean that if markets have fallen for 4 months, 5 months, or 6 months, then it will start moving higher. It's not what it shows you. What it tells you that currently the market is dominated by sellers. Okay? And when the market is dominated by sellers, usually you will get bargains. And wherever you are getting bargains, that is a place to go to, right? And I will show you what those places are. Another important metric that we've tracked or covered is the VIX or the fear index. Now, if you remember in 2024, we wrote a report called the unsettling calm. So if you go to Google and you write the unsettling calm DSP Netra, you will find a full section. In that, we mentioned that volatility in India is so low that it is very unsettling to see, right? Now that unsettling calm is breaking on all numbers. If you look at those numbers have completely reversed. One of the most important metric was very low implied volatility in India for extended period of time. And now it has come back above 25 levels. Why 25? 25 is just a number, a yardstick to look at. It could be 26, it could be 28 also. 25 is important. It shows you that markets can vary around 1.5% on either side, which is the largest move for any single day. In the current crisis, the VIX actually went beyond 25, rose to about 28.9, and since then has remained above 25 for the last few days. This tells you that there is enough panic or fear in the market. And usually, we've done data here. Whenever VIX goes past 25, forward returns improves tremendously, right? The only time they did not improve was the global financial crisis. And also during COVID, the decline persisted for some more days before it started to reverse. But it is very clear that when this fear index is high, increasing equity allocation makes a lot more sense rather than being a fence sitter or selling or reducing equity. That you should be doing the opposite. Um, Next is market breadth, right? Market breadth has been very weak. What does market breadth mean? That out of the overall 500 stocks, which is the frontline 500 universe, how many are declining and how many are rising? One way to judge that is what is the number of or percentage of stocks which are below 200-day average or 50-day average. On both these, we saw readings which were very low. In fact, when we presented and put these readings online, they were lower than our report readings also. These are March end readings. During the month, they were even lower than where they are right now. And which tells you that market breadth was very weak. Once again, same thing that it shows you that sellers are not discriminating between what they were selling, which of course creates opportunities. So all these data points which I told you, we have enumerated here that Nifty has lost price fraud. You've got 4 months and 6 weeks of decline, which is an ideal condition for capitulation. VIX has crossed 25. Once again, a very, very good indication that there is a lot of fear in the market. And most of the time, we are told this cliche that buy when there is panic and fear or blood on the streets. This is it. You can see it on the screen, and that's a good indication. A lot of oversold reading across stocks. Nifty index is below long period average valuations. Breadth is weak. Many heavyweight stocks are at global financial crisis low valuation. Some of them will come up in the next few slides. And a lot of large weights are extremely oversold. So these are some of the conditions. Now we'll go to where are the opportunities, right? So before we go to the opportunity, I want to tell you very, very important that it's very genuine human nature. We believe that something which is continuing will continue to happen, but mean reversion is the main principle of the market. But we tend to extrapolate the present, and that is a mistake. So earlier, 2 years ago, we were extrapolating that good times will roll on, high earnings growth, high valuation will persist because of India story, because of XYZ, because of $30 trillion GDP. If you look closely, all those narratives are gone within a month. Nobody talks about them anymore. People now talk about oil, etc. But nobody's talking about those narratives that GDP will go to 30 trillion, etc. Right? This is the time to think about those ideas. Think about the long term and not to extrapolate the negatives that you see on your screen, because that is what the market is pricing in, right? Then in the next section, we'll talk about where these opportunities are coming. So selective opportunities in high quality sectors, which are these high quality sectors where ROEs are very low. Some of these sectors are highlighted here. Many of them have come below average valuations, right? And that is where the opportunities are coming. Sectors like select FMCG, IT, BFSI, within BFSI, private banks, insurance, some financial services sectors, telecom. These are the places where opportunities are coming up. Incidentally, cyclicals, they continue to remain expensive. And that is understandably one more sector to avoid. Also, we've given a deeper cut on industry subsectors. You can go and read this slide. It will show you where are the large opportunities coming. For example, in case of general insurance, almost all the companies, the almost all the universe companies are trading below average valuations or in the cheap category. Right? So you'll get a lot of bargains there. So you can look at this slide. It will give you a deeper outlook on which sectors and subsectors are giving you more opportunities. Two opportunities we'll talk about. One is large private banks. Now, when you look at the large private banks, collectively they trade at a 2% ROA, return on assets. Their leverage is about 7 to 8 x, the leverage ratio, which means that they can do a ROE of between 15 to 16%. Conservatively, let's say they will do an ROE of 14 to 15%, which is much lower than what you see on your screen. Their historical ROEs are much higher. Now, given where the credit growth is today, 14, 15%, it's very easy that these banks will compound their book value at maybe close to 14, 15% or so. And they are available to you at 2 times book value. That makes a very compelling case to look at private banks. If you remember 2, 3 years ago or 5 years ago, every single investor wanted to buy private banks. Stories were written about them, how they are wonderful, how they are compounding at 20, 25%. And there is moat, no competition. And today they have seen drastic decline in their valuations. Some of the banks which used to trade at 4 times, 6 times price to book are now available at 2 times. On forward earnings, for example, an HDFC Bank is now trading at 1.6 time multiple. It is today cheaper than JP Morgan, which I don't think I've seen in a very long time. Similarly, many other banks. Now, this is a very clear, valuation comfort which has come in these banks, and I think after a very long time. And remember that private Indian banks is one of the very few sectors in India which grows at the nominal GDP plus rate, and it is still growing. Although stock prices will not tell you that, it is still growing. If you look at their banks, they are still growing at nominal GDP plus rate, which is fabulous, right? And therefore, getting them at below average multiples, and some banks are even in the cheap category, makes a lot of sense. This is a graphical representation where banks have become much cheaper, and also their premium versus PSU is completely gone. So there is no price fraud, no valuation fraud, no relative valuation discomfort. And therefore, we think that this is one of the categories which has actually become cheap. And that's why I said, if you follow my line of thought, when market comes to average valuation, you can find sectors which have become cheaper. So effectively, you are buying crisis level valuations in an average market. And that is how you hunt for bargains. The second sector is large IT firms. I will not spend a lot of time. We have made similar arguments in the last 2 to 3 editions. Same continues to be true. In the month of March, this sector did not see a lot of decline. Otherwise, prices would have become even more attractive. One important consideration is that in the next 15 to 20 days, a lot of results for these companies will come. and that will decide the short-term movement for many of these companies. One thing which will be very interesting will be how are the margins shaping up for these companies. If they continue to hold margins, I think this sector will see significant new activity and interest. As of now, the large stocks in this segment are trading at low average valuations, below average valuations. Have they become completely cheap? Maybe not. They have not yet reached that level like private banks. But will they become extremely cheap? I have no idea. But I think it's a fair ask to look at some of these banks, maybe one some of these companies, one or two IT companies from this cohort has actually come to a cheap valuation category. Right? Um, the next is the oil crisis. So before I go to oil, which is a very important, short section which we'll talk about, I'll just summarize on, what I wrote here and what are the key ingredients of our first section. One, we think that the market has become average in terms of large caps, in terms of valuation. It makes sense to up your equity allocation to more moderate level. There is no reason to be conservative anymore. Increasing equity exposure makes sense. Specifically, if you are focusing on sectors which we highlighted here, which can make a lot of sense in terms of portfolio. And there are a number of statistical and valuation readings which we have put out in the report. And one important consideration, um, in bull market, it is very easy to say that I don't want to participate anymore because valuations are not attractive. And over time, you will come out fine, right? Because high valuations very rarely leads to bull market, right? Eventually, the markets decline and they come back to average valuation, average earnings, etc. But bear markets are very different, right? When markets decline and they come to average valuation, there is no way to judge whether they will become cheap or not. Whether a crisis will make them extremely cheap or cause a complete crash in the market, we have no idea or no way to judge it. And therefore, an investor, when he sees value in sectors, should go and invest. And then it is up to our luck, up to the circumstances, up to the future, how they will play out. Of course, it makes sense to keep some dry powder that if that crisis occur, you can become much more aggressive. And that is a difference between being moderate and being aggressive. So this is the time to increase your equity allocation. Maybe a time for aggression can come, maybe it will not come. We have no clue. Only time will tell. One clear, important distinction, always remember the mean reversion principle, that things will mean revert. Currently, our currency, Indian rupee, is highly undervalued. It will mean revert. Valuations have come down. In some cases, sectors have become cheap. They will mean revert. Right? We have seen significant outflows in India. They will mean revert. Eventually, the currency and valuation equation will become attractive enough for investors to come back to India. All these are things which will mean revert, and we should be careful not to bet against them at the wrong time. Now we'll go to the last section, which is on oil. First is, even in the last Netra, I showed you how demand and supply equation continues to favor the bears, right? With whatever you're reading and listening, one thing is very clear: oil prices are yet to touch their all-time high. And if you think about it, that almost 20% of daily global supply is at threat for the last 37 days. And yet oil prices have not breached their 9th March high. This is dramatic, right? And you can ascribe any reason to it. You can say that some people are selling future oil and manipulating it, etc. There are many theories floating around. But imagine that even the physical market of oil is not at lifetime, right? And which is a very interesting conundrum to think about. Second, when you look at the data, the world continues to have more oil, more supply of oil than demand. It remains a big supply chain crisis. Can it become a bigger crisis and boil over? Of course it can. Right? Can it become a issue for supply? For example, some new supply getting hit or large crude oil producers getting embroiled in war. Of course, it can happen. Prices can shoot up. But when you look at the underlying as of today, you will see that the demand driver for oil continue to remain weak. Almost half of demand for oil comes from road transportation, it has not grown for last 8 years. Whatever incremental new vehicles are sold in the world are all EVs. Incrementally, for example, if total fleet was 100 cars or 100 vehicles, if it goes to 102, it is because ICs are going to 98 and four new EVs are getting added. So that demand which gets added does not cause new demand for oil. And that is a big drag on long term oil demand. Secondly, whenever prices jump significantly, it gives a huge amount of incentive for oil producers to put more capacity. And this is, I think, for the first time that in a gap of 4 years, oil has crossed $100. It becomes a very interesting metric for oil producers because it attracts a lot more investment and a lot more swing capacity comes online, right? And it remains to be seen whether it comes to be true or not. Second, how does it impact India? And I've written a headline: Is this the last significant crude oil-led scare for India? Now, this is a very interesting metric and a point of view to think about. That if earlier $80 oil used to worry us back in 2007, then $100 oil started worrying us. Today, that number, I think, to my mind, is around 120, $125. If it goes above that level, all bets are off. We'll have to have a hard economic reset. Economic growth has to be slowed down. Interest rates have to be raised. And what does 120, $125 oil mean? Oil staying there for 1 year, right? Maybe even in 3 to 6 months period, it can wreak a havoc on Indian economy. But we are not there yet in terms of prices. 1 month, 2 month, few days of higher oil prices, Indian economy can easily take. But given that the longer term demand picture for oil is deteriorating and India's economy size is rising, maybe let's say if the next $100 oil or $150 oil comes in 2030, Indian economy will be in much better shape to take it because the size will be much larger. Right? So this scare, I think, is one of the important opportunities that if it is short term in nature, which we will know, right? In the next 30 days or 60 days, we'll know whether it gets resolved or not. We don't have to predict it, whether it will get resolved or not. We'll know it, right? One day, whenever the resolution happens, if it happens in the next 30 days, 60 days, or 6 months, we'll come to know whenever it happens. It's the likelihood that we'll have another scare from oil in the very short term is much lower. And when you look at the balance of payment for India, if oil stays above $120, it becomes a big headache, right? Our balance of payment becomes untenable. We have to cut our demand, slow down the economy, burn a lot of FX reserves to protect the currency, and maybe hike interest rates also. So this recipe is not very good. It leads to currency depreciation, can also lead to large decline in the stock market because financial conditions deteriorate significantly. But once again, think about it that with all the noise going around, oil prices are still not rising, and which is a very interesting facet. Maybe they are delaying, maybe the market knows much more than what we do, but we always take oil price as an input. We will not try to predict it that because of XYZ reason, oil should be 150 or $50. One thing is clear: at $100, we are fine. Over even in the next 30 days, if it stays at $100, India will have some trouble, but it will be able to still consume oil and still able to digest that trouble and come out of the problem. But if it goes beyond 120 and stays there, then probably things compound and become more problematic. So as of now, I think the oil crisis, as we say, if you purely think from a price perspective, it is yet to become an oil shock. It is, of course, a crisis, but from a price perspective, it has not morphed into an oil shock. From a noise value perspective, I think it is much more than a shock. But from a price perspective, it is yet to become a shock. So, in conclusion, we put out a slide on Bob Farrell's 10 timeless investing rules, and we want you to read all of them. But the rule number 5 is very interesting today, that the public buys the most at the top and the least at the bottom. And you can go and see the flows number, you will see exactly the same thing. That when markets are high, valuations are high, earning growth is peaking, optimism is very high, stories are very positive, investors feel very, very confident in the future, they buy a lot. But when markets fall, they correct, they go to average valuation, they come to fair value, stocks become cheap. There is a lot of noise, there is a lot of fear, there is oil, there is geopolitics. It makes us fearful, and that is the reason we do not buy. And that is a mistake. And therefore, we think this is the right time to raise equity allocations, and we'll continue to monitor and write about it in the future. So I will stop here.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.